a new and improved package of communication reflecting the progress that we've made in response to the Bernanke review. In our minutes, the monetary policy summary is shorter and more focused, while individual paragraphs set out the views of individual members of the Monetary Policy Committee. In the Monetary Policy Report, a monetary policy overview sets out the main economic narrative underpinning our decision, and then we have a range of boxes which present the key pieces of analysis that have informed that decision. And the report now presents detailed scenarios with illustrative monetary policy responses in addition to the central projection. Taken together, the new report and minutes are designed to allow us to adapt and respond in a world of greater uncertainty, putting greater weight on the key judgments behind our decisions, emphasising the underlying economics as much as the precise numbers, drawing on a wider range of analysis and framing our discussions within a broader range of risks. So this is a milestone in the response to the Bernanke review, and one that is testament to the hard work and dedication of the excellent staff that do all the hard work. It is, however, today a moment of great sadness for us. During the preparations for the November meetings, we lost a much-loved and respected colleague, Pavandeep Dharmi. Pavandeep was a mainstay of supporting the MPC for a very long time. His insight and his commitment helped shape the documents that we've published today. And so we've dedicated this edition of the Monetary Policy Report to Pav. The new material presents more information about individual views on the committee, but I should say at the outset that we're here today at the press conference to speak to the collective decision made by the MPC, not the individual paragraphs. So on to the substance. Today we've held bank rate at 4%. The start of monetary policy has supported disinflation over past nearly 3 years now. And that progress has allowed us to cut bank rate 5 times, gradually making monetary policy less restrictive, while still seeking to ensure that inflation falls back to our 2% target and stays there. Headline inflation was 3.8% in August and in September, partly reflecting developments in food and administered prices. We expect this to be the peak. Beneath the headline numbers, underlying price and wage pressures have continued to ease. We expect headline inflation to fall to close to 3% by early next year before gradually returning to the 2% target over the subsequent year. But risks to disinflation remain, and we need to wait and see that the downward path of inflation becomes more established before we can cut bank rate again. So where monetary policy goes from here depends on how 2 big forces play out. On the one hand, inflation is still well above the 2% target. It is possible that it could be sticky. For example, if increases in administered prices were repeated or if labour cost pressures continued to be elevated. There is a risk that the inflationary shocks we have had could have affected inflation expectations and the way wages and prices are determined in the economy. That could lead to more inflationary pressure. A scenario in the report illustrates that the path of bank rate might have to be higher than otherwise in response to that. On the other hand, activity in the economy is below its potential. We see this most clearly in the labour market, where the number of vacancies has fallen and employment growth has stalled. There is a risk that households and businesses remain cautious about spending and investment, holding back demand and weighing on job prospects further. And that could lead to inflation falling below our target. A scenario in the report illustrates that the path of bank rate might have to be lower than otherwise in response to that. Now, monetary policy is being set to balance these risks in order to meet the 2% target sustainably, and so that bank rate is neither too low nor too high. So today's decision is based on 2 key judgments. The first key judgment is that underlying domestic price and wage pressures are continuing to ease. Recent data suggests that the risk from greater inflation persistence has become less pronounced, and the risk to medium-term inflation from weaker demand more apparent, such that overall risks are now more balanced. As the central projection in the report illustrates and is reflected in the market curve, this means that we are likely to continue to be on a gradual downward path for bank rate. Chart 1, which has just come up, shows 12-month inflation in the Consumer Price Index since 2021, that's the white line, along with its components, the coloured bars. The increase in inflation over the past year has been driven in large parts by the contributions from energy prices, that's the orange bars, which are no longer pulling inflation down, and higher food prices, that's the purple bars, as well as increases in a number of administrative prices that have held up the contributions from services prices, and they're in the yellow bars. The shaded area on the right-hand side shows how we expect headline inflation to ease again in the coming months as lower domestic cost growth passes through to lower services price inflation. And as we look beyond the next 6 months, the effect of past increases in administered prices should also drop out. Provided they are not repeated next year, that should shave off another 0.5 percentage point or so from services price inflation in the second quarter of next year. As chart 2 shows, disinflation in underlying services price inflation has continued. Although progress had slowed in recent months, high-frequency measures moved lower in September. We expect the pass-through of non-wage labour costs, including from the increase in national insurance contributions, to continue to limit declines in services price inflation in the next few months. But we expect progress to resume next year. And the decline in services price inflation is supported by a gradual normalisation of wage growth. As chart 3 shows, annual private sector pay growth slowed to 4.4% in the 3 months to August, that's the blue line, down from 4.9% in the 3 months to May, and below the projection in the August report. This recent slowdown is consistent with the signals from a range of other pay indicators. And we expect wage growth to ease further into next year. That's the blue diamonds on the right-hand side. There are signs that disinflation is on track. But that is not to say that the risk that the recent rise in prices could feed into more inflation through second-round effects has gone away. The recent pickup in inflation has been driven in part by food and energy prices. These are salient to consumers and often affect inflation expectations. So we have to remain careful that this does not lead to any additional second-round effects on wage and price setting in the UK economy. But while it is only one data point, it is encouraging that the peak in inflation in September was about 0.2 percentage points lower than we had expected in our August projections. Looking ahead, over the whole of our forecast period, as seen in chart 4 here, that's our November projection, which is conditional on the market-implied path for bank rate. This suggests that CPI inflation will fall to close to 3% early next year and then decline gradually towards the 2% target after that. Further disinflation is being underpinned by subdued economic growth. Some economic slack is needed to squeeze out the remaining stickiness of inflation. A looser labour market eases the pressure on wages, and moderate demand conditions combined with spare capacity within firms limits the scope for firms to pass on higher costs to prices. As disinflation progresses, however, there is a risk that activity cools too much or for too long. In our central projection, we expect growth to pick up gradually to solid quarterly growth rates of about 0.5% towards the end of the forecast period. As chart 5 shows, while consumption growth has remained subdued, real household disposable income has recovered. That's the orange line. That should support a recovery in consumption growth in coming quarters. But the pickup in growth may prove harder to achieve if consumers remain cautious about spending in the face of high uncertainty and a weakening labour market. And it has become clearer when I've been on the road with our agents in recent months that the labour market is slowing too. And we see this in the data too. As measured by the ratio of vacancies to unemployment, shown in chart 6 here, further slack has emerged. Not just through a reduction in unfilled job vacancies, as over the past year, but also through an increase in unemployment. So this takes me to the second key judgment. that, if disinflation continues, bank rate is likely to continue on a gradual downward path. The restrictiveness of monetary policy has fallen as bank rate has been reduced. So the extent of further reductions will depend on the outlook for inflation. A gradual approach allows us to assess the balance of risks to inflation, on the upside from more inflation persistence and on the downside from weaker activity, as the evidence evolves. As you can see from the vote today and from the committee members' new individual paragraphs in the minutes, making this assessment involves weighing the evidence on both sides. Different members have reached different conclusions on the balance of risks. Some members think something like the upside scenario is more likely than others, with the policy implications that come with that. Other members put more weight on something like the downside scenario, with implications for their views on policy. And with every cut in bank rate, how much further to go becomes a closer call. At this meeting, rather than cutting bank rate now, there was also an argument to wait and see that the downward path in inflation becomes more established. The latest data point on inflation was encouraging, but it was only one data point. Leading up to our December meeting, we will get more data on inflation and cost pressures in the economy to help us make the right decision, and we will be able to analyse how this year's budget might affect the economy and the outlook for inflation. As always, the MPC remains squarely focused on our remit to return inflation to our 2% target. Before I finish, I want to add a few words on quantitative tightening, as this is the first press conference since our decision in September to reduce the stock of government bond purchases held for monetary policy purposes by £70 billion over the year from October this year to September next year. On the 11th of November, that's next week, the bank will publish its next quarterly assessment of transactions in the Asset Purchase Fund, where the bond purchases are held. Along with a summary and projection of cash flows associated with quantitative easing and tightening under the indemnity to the bank, the upcoming APF quarterly report will include a new measure which will take into account wider implications for government debt issuance and servicing costs, including continuing savings resulting from quantitative easing. This will show a somewhat different picture on the costs. Looking ahead, the bank's policy is to meet the demand of the financial system for liquidity. Our approach is to transition to a demand-driven framework under which reserves will primarily be supplied by repo operations. This allows the bank to reduce the asset purchase facility in line with its monetary policy objectives and thereby reduce the exposures of the bank and the wider public sector to interest rate risk, whilst the bank provides the reserves through lending operations needed to maintain monetary and financial stability. This is important in supporting the operation of financial markets, including the gilt market, and in reducing the future exposure to interest rate risk. So with that, Claire, Dave and I will be happy to answer your questions. Thank you.
We'll start with Ed and then Maureen.
Sorry.
Hello, Ed Conway from Sky News. As you mentioned, Governor, there's a budget coming up later this month, and everyone knows, and the Chancellor has kind of signalled that there is going to be some fiscal contraction. Obviously, we don't know what happens until the budget itself, but I just wonder, could you give us a sense of the extent to which that played a part? Just that the sense of this impending budget played any part in your decision, or indeed the decision of the committee?
Well, thanks, Ed. We only know one thing with certainty. That is that there will be a budget on the 26th of November. Well, actually, I'll tell you a second thing with certainty. That will be before the next meeting of the MPC. So we will have opportunity to consider the budget in the next round. As I'm sure you know, because we've said it many times, we condition our view of the economy and our projections on announced fiscal policy. So the projections that you've seen here and that are in the report are conditioned on the fiscal policy that was announced in March. It's not for us to speculate what's going to be in the budget. That's for the Chancellor to announce in the budget, and we'll then respond to it.
Maureen.
Hi, Mehreen Khan from The Times. Just to follow up, the Chancellor made quite an unusual decision to do a pre-budget speech, which actually was a lot about monetary policy. She kept repeating her insistence that she wants to help you out in the fight against inflation through her fiscal policy. Governor, given that you had the decisive vote, I'm interested in whether you didn't seem to have been convinced by her message, particularly given your assessment of the economy seems to be that actually the risk to inflation are a little bit less pressing, as you say in the report. And finally, the other message the Chancellor had is that everyone in the UK needs to be in it together. We all need to play our part. Does the Bank of England also need to play its part in the situation the economy and the public finances are facing?
Well, thanks, Maureen. I mean, in no sense are we passing any judgment on what the Chancellor said this week. As I've said, our very, very clear convention is that we condition our view on what's been announced. So we will do that. We have done that this time, and we will do that again next time. By the next time, there will be a new announcement. So we will have new fiscal policy to assess and condition our view of the economy on, and that's what we will do. So in no sense are we passing any judgment on what the Chancellor said this week. That should be very clear.
Sam and then Darshini, please.
Thanks, Sam from the FT. Governor, in your statement in the minutes, you allied yourself with a forward-looking Taylor rule and a similar market path, which points to 2 more cuts and things levelling out at 3.5%. Is it fair to say that, therefore, you now see 3.5% as a terminal rate for the bank? And could you give a sense of the debate and the range of views on the committee as to where the terminal rate would be? And just another follow-up on the budget. For you, again, personally, would it have been quite a closer call for you now in terms of cutting rates immediately if you didn't have the advantage of waiting until the budget had been held before and getting that on board before moving?
Well, let me take that question first, and I'll come back to the question on terminal rates. I think there's a very important point which I think you'll pick up not only in my paragraph, but actually other paragraphs, which is, and I mentioned it in my opening remarks, we've had one inflation number which came in under our projection. That's obviously very welcome. I think it does suggest, as I said in my comments earlier, that we've reached the peak. But my own view is, and I think colleagues share this in some measure, that of course we really do need to see more than one number to establish that is sort of in the picture, as it were. So I will be looking very carefully at, as I just said, at the data that we will get before the December meeting. That will be a very important consideration for me. So yes, we will have a new fiscal policy by that stage to condition on, but really importantly, we will also have more numbers. And I'd emphasise that because we always have more new numbers, obviously. But the point is that we are at quite an important moment here because we've had one set of inflation numbers, which I think can give us some encouragement, can point us in a direction, but we need to see more than that. Coming back, your question on first of all, I mean, I think all of us chose our words very carefully. For me, the market curve at the moment does give a reasonable view of a sensible path. By the way, that's not always the case. I mean, sometimes we've sat in this room and not been quite at that place, so I can't guarantee you that'll always be our view. On the terminal rate question, I think it's probably quite clear also from comments, not only in this set of minutes, but in other comments the committee, as members of the committee have made, in speeches they've made. I mean, we do divide somewhat into 2 camps. I don't want to overdraw it. There are those who I think who do take a view that, they do take a view on R-star and on the so-called, if you call that the terminal rate. There are those, and I'm in this group, who don't actually, frankly, feel that there is enough confidence around any measure of an equilibrium terminal rate, and that when we look at this question of restrictiveness, we're looking much more at the evidence on the sort of the change over time, as it were, in the path of restrictiveness, rather than looking at the terminal rate. But anyway, Claire may...
Yeah, I mean, happy to. We've set out quite a bit, actually, in the report in the risk sector. There's a chart 3.4 that shows you all the different ways that we look at this. I mean, our analysis is the policy is still restrictive. There's, as Andrew says, a difference of views. Some members have sort of raised this in their paragraphs about it. I mean, it's quite determining how restrictive you are and issues around turn rate, obviously quite complicated. It's quite challenging. It sort of gets more challenging as you lower rates, right? Yeah. So, we've sort of said that, but there's quite a lot of material in here that we've shown on this, and as Andrew says, the individual powers, I think, also give you a bit of a sense of how different people look at it. There is a difference of view, both about what the, debates and discussions around what the levels may be, but also around these more sort of philosophical questions about, actually, how do you know, how do you try and work it out, how important it is to you in thinking about your policy. And again, you can see that in the difference of views here, with it being a bigger issue for some people than for others.
The only thing I was going to add, because again, as part of what we've done today with, I'd agree with Andrew. This is a milestone in terms of responding to the Bernanke review. Is that we are trying to be as open as we can about, for example, the various risks. So one is this point about just how restrictive is the monetary policy stance. Just to reinforce something Claire just said, one thing that we've added this time, as rather than just repeat the mantras about that there's a range of views on restrictiveness, is that some of us do put more weight than others on these quantitative estimates. But there is something in the minutes in para 12 where we say that, as bank rate approaches neutral, the contribution of monetary policy to underlying disinflation would become harder to discern, making the case for further policy easing more finely balanced. So this notion that, because we've been able to reduce the degree of restrictiveness, we would all agree that we're getting closer to the neutral rate or the terminal rate. So, that gives you some sense also that the debate and the way we're thinking about this is inevitably going to evolve and change in the future.
Darshini, and then Halia, please.
Thank you. Darshini David, BBC News. Another budget one, I'm afraid, but in terms of last year's budget, because the MPC have been increasingly clear in your reports in recent months about the role that measures such as the increase in national insurance, national living wage, have played in increasing price pressures and wage pressures. To what extent has that contributed to hesitancy over the last year when it comes to the cutting of interest rates? And if I may too, you've highlighted the risks in the stock markets in recent weeks and months. And particularly when it comes to AI stocks. Now, those concerns have gathered pace somewhat over the last few weeks. Can you give us an update on your thinking there?
Sure. I'll repeat something I know I've said before, but I think it's important and I can sort of update it a little bit. Of course, for us, the big question was how would the change in national insurance contributions pass through? What was going to be the transmission of it? It's something we spend a lot of time on. When I go around the country, I'm afraid it's the first question that businesses get from me usually, which is, can you explain to me how you've responded to it? And we've set out in the past, there are a number of channels working through sort of margins, employment, wage settlements, investment to improve productivity. That takes rather longer, and obviously prices. I think I've said before, in the early days, obviously, and they're not mutually exclusive, by the way, there was a sort of tendency to tick all boxes. I think over time, I would say that the two labour market stories have probably come a bit more to the front of the responses we get. So I say, people who are not, employment has reduced. Now, by the way, I think that comes more through not hiring than, we're not seeing much of a pickup in redundancy measures, for instance, but I think it comes more through the channel of not hiring. And I think some others then say, well, actually, no, our wage settlement was lower than it would otherwise have been. That, by the way, is also affected by the interaction with the national living wage, because if you've got more people around the national living wage, that channel is not as open as it would be if you haven't. So that's a relevant consideration. So I think we've picked up some more of that, as I would certainly say so. On the stock market AI question, I just say one thing about this. It obviously is something that we look at very carefully, and you'll be hearing that we're going to do it. The next thing we'll produce is the next financial policy report. So, you'll be hearing more about that on the financial stability report. But one thing I would say is this, because I think I've read a number of articles that have questioned this. It is, of course, perfectly possible and perfectly consistent that AI could be the next big mover in terms of productivity. So it could be the next general purpose technology. My own view personally is I think, more likely than not it probably is, but we've still got quite a way to go to actually sort of see that demonstrated. At the same time, we could have a bubble, because obviously the markets are pricing the future stream of returns from this, and that's uncertain. And so, those two things are not inconsistent. The markets could overprice the returns, but the returns could still be substantial. So we'll see. But we are watching obviously the implications for financial stability, and then the pass-through that could happen into the broader economy, such as covered here in the monetary policy report. We, of course, will watch that very carefully.
And just to reinforce that point on the reason we've also flagged this risk in the monetary policy report is because were that bubble to deflate or burst, that would represent a tightening in financial conditions, that would weaken global demand, and that would have spillovers back to the UK. So it is relevant to us on the MPC as well as the FPC.
Helia, in the middle there, and then Phil Aldrich.
Helia Ibrahimi, Channel 4 News. You haven't cut interest rates today, and clearly, Governor, you are the deciding factor. How do you explain wait and see to families at home who are struggling with mortgages and loans if you say inflation has passed its peak?
Well, I want to see more evidence that it's passed its peak. I hope it and believe it has, but frankly, as I said before, in response to the earlier question, we've only seen one number so far. So I want to see more evidence. That's why, I've made very clear, you can see it in quite a bit of the commentary, including my own paragraph, that this is an important factor. Now, I think the best way I can put it is, I think these two big risks that I was talking about earlier have, in my view, become more balanced since we were last sitting here in August. I think that's the way to put it. But the best thing we can do for families, as you say, is get inflation back to the 2% target. That's not only the best thing we can do, it's the thing we must do. And therefore, I'm encouraged that we've seen this one number, but I do want to see more of it.
And inflation is at 3.8%.
Yeah.
So, that's a long way above the target. We're forecasting it will come back to 2%, and that's conditioned on the market curve. But 3.8 is quite a long way above 2.
We'll go to Phil here and then Joel at the back.
Thank you. It's Phil Aldrich at Bloomberg. There were two scenarios in the report today. I just wondered why one of those scenarios wasn't a fiscal scenario, given that the most immediate issue on the horizon is the budget, which it seems very clear that there's going to be consolidation at that point, and what that might mean for your reaction function. And just on, you mentioned regulated prices. The Chancellor is looking at, or supposedly looking at regulated prices. If she took action on that, would you welcome it?
I'll get Claire to come in on the scenario. Just on your points about regulated prices, can I go back to something? It's a totally fair question, Phil. Can I go back to something I said in my opening remarks? I mean, the important thing, of course, is what we see in terms of regulated price increases next year. Because obviously, sorry to state the blindingly obvious, but inflation is an annual calculation. So we have these things called base effects where the effects drop out. The question, of course, is what comes next, and that will be very important. And I think that is a point that has been, taken by the government. I think you can see this from some of the things they've said. And I think if you go back to the point I think Darshini was making about what the Chancellor has said, I do think that it is a point the government has taken about the impact that these things can have on inflation and therefore on policy setting, and that's important. I'll hand over to Claire on the scenarios.
Yeah, and actually just on that, you can see the impact at the moment, the 3.8 number we're talking about. We think about 0.4 of that is these sorts of administered prices at the moment. I mean, on the scenarios, we've chosen these quite clearly based on the fact that they are the biggest issues in thinking about inflation and setting monetary policy to get it back to the 2% target. So, there is this question about how do we think about this balance across the economy of the risk that inflation proves to be more persistent for various reasons, whether that's structural change because it's been higher for a longer period, could be all sorts of issues. So that's one scenario that we have to think about and take very seriously and explore. On the other side, there is this sort of weaker demand scenario, which could come, potentially through the labour market or could come through what we're seeing in consumption, where again we've seen consumption being weaker than we've expected for quite a period of time. So we've selected the scenarios based on the fact that they are the most relevant things for the policy committee in thinking about inflation. And as you can see from the way in which different members have set that out, that framework is one that everyone's sort of consistently using and puts different balances on those two sort of forces, as Andrew described them, in terms of what's driving inflation.
Do either of those reflect the potential fiscal outlook from the budget?
So what we've done on the assumptions we raised, as Andrew said, what we do is we condition all of our work on the announced fiscal policy as it stands now. So that's the fiscal stance that was set out at the last budget.
Joel and then Philip.
Thank you very much. Joel Hills, ITV News. Governor, ITV viewers will take the view that strong pay growth is rather a good thing. Thank you very much. Could you just explain to them why the bank takes a different view? And also, your Deputy Governor said in a speech in May that she thought a sustainable rate of pay growth is around 3% or potentially a bit higher. How confident are you we will get there in the next few months?
Well, I'll take the first part, and then Claire may want to comment on the second part, because we have quite a few deputy governors, but I think it was actually Claire you're talking about here. So, look, pay growth, as we say in almost I think in every report, and I was saying earlier, obviously is an important determinant of inflation. It feeds through. That said, of course, one also would expect a relationship between realised inflation and wage bargaining going forwards. And that's why we put a lot of emphasis, as I mentioned earlier, on the question of inflation expectations and how those pass through. Now, obviously inflation has come down substantially from where it was 3 years ago, and we've seen wage settlements adjust down over time. But the emphasis that we've put over in almost every report since then on the question of persistence is all about the question of to what extent there will be continuing effects, this potential effect working through things like expectations. So we will continue to look at it very carefully. What I would say is that we have been through a period where pay settlements were well above the level that all of our models were suggesting they would be. I think that may well be related to some evidence that we've had, over that period of time, a negative shock in terms of labour supply. There's a lot of questions about how we measure it at the moment and the uncertainty around the data. What I would say is the evidence, pay settlements are coming down. We seem to be likely to hit towards the end of this year around about the level that our agents in the survey they did at the beginning of this year sort of thought they would be. So they do seem to be tracking downwards, but that and where they go, henceforth will obviously continue as always to be an important part of our considerations.
Yeah, let me pick up, because that isn't quite what I said. What I did was I set out a set of basically ready reckoners on what sort of level of wages would be consistent with the inflation target, depending on what you assume about productivity and what you assume about import prices. Actually, most of those estimates were higher than 3%. I mean, wage growth is obviously something that we look at really carefully. It's 4.4% at the moment. That is higher than a target consistent number. We expect it to be coming down. It's one of the bits of evidence that we're going to be looking at very closely. I mean, as it is in our current forecast, we do have it at 3% towards the end of the forecast, consistent with the target. But it depends on what you assume about all these different variables. And that's what I was talking through, just actually how do these ready reckoners work and what do you think about import prices and productivity and how that affects.
And what do you assume currently? What's a sustainable rate of pay growth?
Well, as I say, in the forecast that we have at the moment, towards the end of the forecast, it comes down to 3%, and that is where we also have inflation at 2% at that point. But, as I say, that depends on a number of assumptions that are underpinning that forecast, and of course we have some different scenarios that we've also looked at. So it's a good example of why you want to look at a whole range of things. We have quite a lot of discussion of this in the report. because of it's important to us in terms of these underlying drivers of inflation.
And it's worth saying that a key underlying assumption that means that 3%, which is what we're forecasting for Q2 2027, would be consistent also with inflation returning to our target, is that there will be some productivity growth, around about, I think, probably moving up towards 1% or so. But that's the, that's how you can kind of make those two things consistent. But there's uncertainty around productivity, and it is absolutely critical that there should be some productivity growth.
There's also uncertainty about input inflation at the moment as well. So it's not as straightforward as you might hope.
Philip, and then Sue.
Hi, Philip Hinman from The Guardian. I wanted to take a slightly different tack, which is to look forward to next year when you have a forecast for growth slowing, you have unemployment rising, and yet wouldn't it be reasonable for the public to think that you were more accommodative than you are planning to be? You still have restrictive interest rates next year when the economy is quite clearly suffering under your scenario before it recovers in 27 and 28. Why do you still hold that? Wouldn't the public think that it's reasonable for you to cut rates faster in that scenario?
Well, in terms of judging the restrictiveness of policy, I think it comes back to the answer I gave to Sam's question earlier, actually, which is, as we look forwards, this question about how restrictive policy will be at any given point in time. In my read of it, I always say, look, it depends on how the change in monetary conditions evolves. I don't have a view on the terminal rate. I don't fall into that school, frankly, because as I said earlier, I think just to be technical for a moment, the standard errors around those two estimates are just too big. So what that means in practice is that every time we meet, we have to rejudge this question in the sense as to how restrictive is policy, and that's got quite interesting over time. I mean, I'd give you the most obvious element of this question, which is mortgages, because the mortgage market in this country has changed fundamentally in the last 15 years. It's gone from being a variable rate market to a fixed rate market. That means that actually the transmission of monetary policy takes longer, comes through more slowly, comes through in parts, because obviously it depends on the balance of the mortgages that people have. And so we have to keep coming back to this question as well, and this is a point I think Dave was making, into financial market conditions and rejudging this restrictiveness question. And as I think you can tell from the individual paragraphs, there are different views on the committee about just how restrictive policy is at the moment. So some of my colleagues would I think push back at you and say they don't think policy is particularly restrictive at the moment. I think that it is still restrictive, but as we said, as Claire was saying earlier, and I would agree, the degree of restriction is reducing, which sort of is consistent with cutting, obviously, and we will have to judge that question going forwards about how restrictive it continues to be meeting by meeting.
Can I add a point on growth, which I think is quite important, which is from an inflation perspective, it depends what's driving the weak growth that really matters, and you can't necessarily assume that because growth is a bit weaker, and actually, we do have growth sort of strengthening through the period in our, it's, it rises a little bit towards the end, but it's really important to think that, depends what's driving the weak growth and whether that is about the level of demand in the economy or the level of supply, and that has very different impacts for inflation. So it's one of the ways we have to sort of think about this. You can't necessarily assume that weakness in activity is going to necessarily reduce inflationary pressure.
That's right. I mean, I've said in a number of speeches I've given recently that I think the biggest challenge we have in this country, and by the way, we're not alone. I mean, we're in company here, is that the potential growth rate has fallen over the last 15 to 20 years.
Sue and then John Paul.
Hi, Sue Chan at The Telegraph. Just following up on questions from Darshini and I think Phil, just stepping back a bit and looking at the last year, would you say government policy on things like the minimum wage, the national insurance increase, packaging taxes have helped or hindered your fight against inflation? And in general, are government interventions to bear down on prices welcome, or should policymakers stick to their knitting to allow you to stick to yours?
Well, it's interesting. I think we first, in a sense, drew attention to what we tend to call this hump in inflation in the February inflation report, so 9 months ago, I'm talking about. And actually, when we look back at the February monetary policy report and sort of the shape of that hump, it's a point Dave's made to me a number of times, he's nodding, it looks actually rather like it does today. We've had a few changes in between in what we thought might happen, but it actually looks right. And one of the reasons is that, as Claire was saying earlier, part of that is these so-called administered prices. Now, they do have an impact. And so, it is something that we've drawn attention to. And I think the second thing is that the pass-through of national insurance has not been that different to what we were expecting at the time. So those two things have more or less transmitted. Now, in terms of, it's for government to decide its own policies, because government has all sorts of other public policy objectives. I mean, we're one public policy objective, and I use public policy broadly there, obviously, as a term. And there are many other public policy objectives. So, give you an example, in the administered price regime, part of that is water bills. Well, fixing the water system is a public policy objective. It's not Bank of England's public policy objective, but it would not be for the Bank of England to go around saying no attention should be paid to fixing the water system. That would not be, I think, a very sensible thing. So we have to take account of these. I think we do have to draw attention to the effects of these, which we do, obviously, and then factor them into our outlook.
John Paul and then Anna.
Hello, John Paul Ford-Rojas from the Daily Mail. Couple of things, please, Governor.
Could you talk about, I'm sorry, the acoustics in here are sometimes quite variable depending on where you're sitting. If you could talk a little bit, it would be really helpful.
Yes, sorry. John Paul Ford-Rojas from the Daily Mail. A couple of things, please. First of all, households are worried about income tax going up, perhaps in the order of tens of billions of pounds. How much relief or reassurance can you give them that were that to happen in the order of that, all else being equal, that would provide an impulse to the bank to cut interest rates in December? Secondly, with your regulatory hat on, with car finance and the compensation scheme that's currently proposed by the FCA, you're the regulator also for banks. Banks are suggesting it would be disastrous and damage the economy. The FCA pushing back on that. Do you have a view on that issue, please?
Well, the income tax question, I'm afraid I'm going to give the same answer. It's really, of course, it's obviously for the government to decide what the budget's going to be. The Chancellor will announce it, and we will take it into account. The economic modelling for the budget, of course, is done by the OBR, not by us, and that's important. So, we will assess what is announced by the Chancellor in our next round, and that's the right way to do it. So we're not giving a message on fiscal policy today because we'll wait and see what fiscal policy is. On car finance, look, when we do the next event in here, it will be, as I said earlier, the financial stability report. We will also be publishing the bank stress test. I think I'm right in saying that. Yeah, we will. And so we obviously have taken all that into consideration for that. So you can look forward to that. I think it's next month, early next month. Don't hold your breath though for all the month long. I wouldn't advise that. Literally, that is.
Anna and then Ryan.
Hi, Anna Wise from Press Association. You say you're concerned about the high level of household saving. Can you explain what's driving this? Is it a long-term shift in behaviour, and how much are you having to take that into account?
Yeah, I'll get Claire to come in. Of course, when we say concerned, I mean, it is what it is. We're very interested to assess. Your question's a very good one, actually, as to why it is, because that's relevant to our outlook.
Yeah, sure, happy to. And as Andrew says, when we say we're concerned about it, it's one of the factors that is feeding through in our judgment on the level of demand in the economy and therefore inflation. Obviously, it's for households to choose. want to behave. I mean, in terms of, we've spent quite a lot of time looking into this because consumption is such a big part of the UK economy that it's a really important driver of what we expect to happen. And in fact, we've got quite a detailed box on this in the report. It's unclear. We've done a huge amount of sort of investigating into it. So some things are quite obvious, right? So interest rates are higher. That obviously incentivises savings and that drives some of the behaviour. There may be some sort of what we call precautionary motives. And if you ask households why they're saving more, they do point to those sorts of things, not necessarily around the labour market, but in general more a response to sort of uncertainty and risks. The other thing that we've had a bit of a look at is this question of are people trying to sort of rebuild their wealth following some shocks. So it could be a combination of things. We've looked at it in quite a lot of detail. It is one of the big drivers, and you see it come out in what a lot of members saying about the risks as they see around the economy. So it's something that we're really focused on. As I say, consumption being over 60% of the economy, it's a big driver of demand.
And just to add to that, we've actually tried to quantify in the downside scenario what would happen if savings doesn't fall back, which is what we've got in our central projection. For, as Claire was saying, those precautionary reasons. So if you think about the mechanism is savings staying higher, and then we've quantified the impact of that on consumption and GDP. So again, we're trying to sort of not just describe the risks, but also give a sense of what that alternative future might be with the downside scenario, which some members put more weight on than others then in how they vote.
Ryan, who's just there, and then Ritika right behind him.
Thank you. Ryan Saby from The Sun. What's your message to households when it comes to food inflation, especially with global and domestic cost increases, sees that those prices remain elevated? How can you explain that outlook for the next year, 18 months or so?
Well, again, I think in this story that, we've had this hump in inflation over the course of this year. Food is another, as we set out, another component of that. It's about another 0.4, isn't it? I think, something like that. And we thought, and I think we said this probably last time, that probably the peak would be around about sort of the later part of this year. Again, tentatively that looks like it is the case, which is obviously good and helpful. The components of that, as we said before, a bit of a mixture. So there's an element of global commodity prices. It's not spread across the board. It's quite concentrated in a few commodities. Coffee is one of them, for instance. There's some labour costs, undoubtedly, in there. And our contacts do mention the packaging tax as well. That's another element of it. So there's several components of it. The other thing, and I think I mentioned this earlier in my remarks, interestingly, our staff has actually given us some interesting analysis on this. There's a lot of analysis that says food is particularly salient in the inflation basket for the obvious reason that, in a sense, we all buy it very frequently. I was going to say every week or whenever, but I mean very frequently. So we tend to sort of, in our mental map, we can carry around the cost of food more than, say, a flat screen TV, which, well, I only speak for myself, I don't buy very often. It is salient. Now, so therefore, there's a sort of, there's a reasonably well-established view that actually, therefore, in terms of forming inflation expectations, these things will weigh more heavily. Our staff have actually presented some interesting analysis to us suggesting that may not be the case. So, jury's out a bit on that one. But look, it's really, obviously, to your question, really good question, it's really important, obviously, for people, because food is such an important part of the consumption basket. And can I say more so, because for those on lower incomes, food and energy, of course, are an even bigger part because they're the essentials of life. It is important that food inflation comes down.
Ritika's just there, and then Maurizio.
Ritika Gupta, CNBC. Governor, given the MPC sees a slack opening up in the economy, you've outlined weakening demand or weakening labour market, do you ultimately think that interest rates are going to have to go below neutral in order to close a negative output gap?
Well, I'll bring Claire in. I think there's two parts to this I'd emphasise. One is, what is the level of slack? The second is, how does that any given level of slack influence wage and price formation? It tends to be called the Phillips curve relationship, as we tend to call it. And those two things are both highly relevant. I don't know what you want to...
Yeah, I mean, sort of not necessarily is the point. I mean, look, to come back to this point, that we have inflation at the moment that is 3.8, is higher than it should be, and it's, you know, we're quite far from a target consistent level. So the slack is unfortunately needed to bring inflation back to target. It's not necessarily needed. If you know, it doesn't necessarily mean that interest rates have to go below their neutral level, because we think we have some now. It's a very uncertain. It's a very sort of hard thing to judge, and you know, we spent a lot of time thinking about it. But we do think there's slack in the economy now, and that will sort of widen slightly.
Maurizio and then Joel at the back.
Hi, Maurizio Allen-Carr from City. Just wonder, with this decision today and the minutes in your report, what message you're sending to markets and to business confidence? Is holding interest rates going to weigh down on business confidence, given, you know, expectations of fiscal restraint at the budget and, you know, a lot of other sort of geopolitical uncertainty at the moment? Thanks.
Well, can I? Yeah, it's a very good point. So let's try and boil it down a bit. We talked about sort of two sort of risks that we have. One is that higher inflation becomes embedded more, and the other one on the other side is, going back to the previous question actually, is that we get this weaker demand story coming through. Going back to the earlier question, that, you know, as Dave was saying, that, you know, consumption doesn't correct, saving rate doesn't correct. And those two things, you know, are what we're sort of steering between. Now, I think those two risks have become more balanced than when we were sitting here. They were, in my assessment, when we were sitting here in August the last time we were sitting here. I do think we're now in a more balanced position. And I just use again the phrase that I used in my opening remarks. I think rates are on a gradual downward path, but the judgment about when and by how much is going to be very conditioned by how we see this balance of forces going on.
Joel at the back.
Thank you. Joel Suss, Financial Times. I want to just come back to the terminal rates. So in this NPR, you've added simple policy rules as a way to illustrate how bank rates should evolve under the central projection in different scenarios. But of course, the simple policy rules require an estimate of the neutral rate, which you've set as 3%. So I just wonder how we should read that, especially in relation to the market rate of 3.5%, your own stated position of 3.5% seeming right at this point in time. Is 3% the default or average view of the committee? Should the committee be plugging in different estimates of the neutral rate? Thank you.
There isn't an average view, because as I said earlier, you know, some members put more weight on estimating a terminal rate than others. Yeah,
look, let me pick this up. I mean, really pleased that that people have sort of spotted this policy rules material. I think it's a good innovation, and it's something where we're trying to be a bit more transparent about the sorts of information that we look at as a committee. I wouldn't take from it anything about, you know, we're giving any sort of steer or indication about neutral rates. There's a very lively debate across the committee on this. What these rules are really useful for is helping you think through, you know, how you think about policy looking forward. What are the things that drive you? In some cases, you might think some rules are, you know, more appropriate if, for example, you think that the forecast at 12, 18 months is a pretty, you know, is a good indication. You might put a bit more weight on the forward-looking rules. If you think actually some of these equilibrium variables are a bit more uncertain, you might be more interested in your first difference. So the idea really is we're showing you the sorts of things that we look at because they're part of the debate that we have. We're not trying to either directly or indirectly send any signal about this much broader question of neutral rates, where we also discuss that very directly in the report when we look at, you know, all the different ways you can look at it and what that might be.
The only thing I'd add is that, I mean, this is an issue we faced in the way we've, I think, quite rightly taken the report. Obviously, with the central projection, we condition on the market path. once we introduce scenarios, if we condition the scenarios on the market path, we'd be really suffering an apples and oranges problem. You'd rightly say to us, hang on a minute, I mean, that doesn't really work. So we face, well, what are we going to condition them on? And I think using rules in the way we have, not using a rule, as Claire said, but more than one, but not too many, is the sensible way to do that. Not because we follow them, but because they're sensible sort of conditioning assumptions, and they give you a sense as to how we think about them.
Michael, and then Delphine.
Michael Race, BBC News. Regarding concerns about food costs and consumer spending habits and overall consumer sentiment, rather, how concerned are you that the public is somewhat scarred by the inflation shocks that have gone in recent years, and what impact do you think that's going to have in the coming months, years?
Well, it's a very important consideration. It's lain behind a lot of the thinking we've done on this question about persistence of inflation, that would the public feel, well, once it's in the system, it will stay in the system. Actually, I would say the big inflation we had 3 years ago, the numbers came down quite rapidly. That didn't surprise me because, a lot of those shocks were very specific shocks to do with COVID supply chains and to do with Ukraine, for instance, impact on energy prices and food prices again. But it is a very important consideration for us because it comes back to this point about how expectations are formed, what the influence is. And that's very important for us because, of course, it's a very important factor in shaping how we set policy because we have to respond to that.
I mean, in fact, I would just add on that. Inflation was very high. It was very difficult for people. You would expect that, therefore, to have changed the way people think about their own finances, the economy, and we have to think about that in terms of what will that mean for how behaviour may or may not change. And so, always when you have a shock that's quite far outside, what you're used to, it can change some of those relationships. And so that's one of the things we really have to think about and think about what will happen for inflation in the economy going forward and how best do we sort of understand that. And again, that's why some of the scenarios and some of the things that we've presented here try to get into some of those questions.
Reading the agents report, it's quite clear sentiment is very flat. I mean, are you generally thinking that this is going to have an impact over a sustained period of time?
Well, I would come in on that as well because we are still having to deal with the consequences of all these shocks and that over recent years, and so this scarring can both be in terms of perceptions of inflation, but to your point about activity being flat as the agents have described it, we also talk in the box on consumption that Claire was referring to earlier about the potential scarring effects on consumption from the high inflation, that it may lead to a more precautionary approach. So, these kind of complexities are playing out across different parts of the economy.
Go ahead, Delphine, and then last one from Francine.
Thanks. We've had lots of talk from policymakers over the last couple of years about a crisis of economic inactivity and joblessness. And it was interesting to see in your analysis that you think participation is actually pretty much bang in line with what you were expecting before the pandemic. Is that because things have improved recently, or was there a massive misdiagnosis?
Well, there are levels of uncertainty and levels of uncertainty. I think the uncertainty in this area is very high. I mean, I think you can see from what we've published, you've got two different official measures which actually give you very different paths of how this thing has evolved. So I have to be honest with you, I mean, I'm starting to speak for myself now, for my own judgments. I am reserving a lot of judgment on this question as to where it actually is at. It's we've said before, it's the hardest thing to measure. It is. I mean, it's harder to measure than many other bits of the labour market. So given that uncertainty, given the fact that I say we've got two official measures which do tell different stories about the path, I'm certainly reserving judgment on this question.
I mean, not least because the improvement has happened very recently.
Yes.
So we've kind of got back to that pre-COVID level in the latest data, and it seems to be more apparent amongst female participation than amongst men. So you can tell stories that explain it, but it is a very recent development, hence why Andrew and the rest of us to varying degrees are saying, well, look, this is the participation puzzle may be starting to resolve itself, but we need more evidence.
Last one, Francine.
Thank you so much, Francine from Bloomberg. Governor, how do you think the neutral rate has actually evolved over the last decade?
Well, having said, of course, that I don't have a neutral rate about it, I think that's a slightly different question. So I think that if you look at the long-run neutral rate, then it's influenced by much more sort of big global factors. And the things that influence that are, one, the aging population, because we all save more as we get older. That's the sort of life cycle hypothesis. And so if you have a population that is on average aging, that will probably increase the stock of saving relative to investment. That would push the long-run neutral rate down. Now, if we get, of course, a pickup in investment demand, which you're probably seeing at the moment more in the US economy than you are in other economies, then that would correct that, if you like. So if you look at something like the AI investment boom in the US, then you'd say that might be something of a correcting factor. And so these are global trends somewhat, so that might go the other way. But that's the sort of framework. I mean, it's the saving investment balance, the impact of productivity change to the extent that's driven by innovation and investment that tend to be the longer run driving factors in those calculations.
I mean, it's probably fair if I can just add that we've talked about a range of estimates for the neutral rate between 2% and 4% before. Most analysis would suggest that to the points that Andrew's making, plus if you add in, say, fiscal, you might say that the neutral rate has gone up a bit compared with 5 years ago. But that doesn't really help you at all with where it is in that range of 2 to 4%.
Thanks very much, everyone.
Thank you.